We're analyzing TC Energy, stock ticker TRP, to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for TC Energy. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing TC Energy for your stock portfolio. Before we get into these valuable metrics, let's understand TC Energy stock performance. Right now, TC Energy trades for $38.59 per share. Year to date, their stock price is down 1.5%. Right now, TC Energy pays a huge 7.1% dividend yield. Their average dividend yield is added to the returns in their stock price. In the last 5 years, TC Energy is down 3% annually. They're down 13.5% overall. In the last 10 years, they're down 12% overall. Going back before the global financial crisis, over the last 18.5 years, TC Energy is compounding at 2.5% annually. Again, their average dividend yield is added on to these returns in their stock price. TC Energy trades just $2 above their 52-week low. The company's down nearly $20 from their 52-week high. TC Energy is a big business. They have a $39.5 billion market cap and an $86.5 billion enterprise value. But the burning question is, why should we be paying close attention to TC Energy? TC Energy operates natural gas, oil, and power generations assets in Canada and the United States. The firm operates more than 60,000 miles of oil and gas pipelines, more than 650 billion cubic feet of natural gas storage, and about 4,300 megawatts of electrical power. TC Energy was formerly known as TransCanada Corporation. It changed its name in 2019. With this understanding, let's get into the numbers. Starting with metric number 1, we want TC Energy's average return on capital over the last 5 years to be above 14%. The average business earns about a 7% return on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. TC Energy, as both a midstream and a utility company, is going to have a hard time hitting this benchmark. They earn about average returns on capital through most of these years, averaging about 6.6% returns on capital in a given year. In large part, this has to do with their big amount of fixed assets. TC Energy earns just below average returns on capital in a given year, meaning they're coming in below our benchmark. This is an X on metric number 1. Metric number 2, we're looking for growth. We want to see growth in their revenues, net incomes, and free cash flows. All three have to be up for this to be a check. This metric's all or nothing. We'll use their numbers up until today in our calculations. In this time, TC Energy has grown their revenues by 14%. Their earnings are down pretty massively. Their free cash flows were negative in 2018, and they're still negative today, although they are less negative. Both their earnings and their free cash flows are still down. This is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years for TC Energy. We learned their earnings are down over this time, and at the same time, TC Energy has diluted shareholders by 11%. This is a 1-2 combo that lowers their earnings per share. This is an X on metric number 3. For midstream businesses, typically we're just looking at their shares outstanding, but for TC Energy, due to their power generation component, we were still factoring their earnings. Either way we look at it, this is still an X. Can the business turn it around in the second half of our analysis? Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This combines our last two metrics. In metric number 2, we learned their free cash flows are negative. They're less negative than where they were at in 2018. While technically this is still growth, we won't give it to TC Energy. We want companies that are generating positive free cash flow and generating cash for shareholders. With negative cash flows and 11% shareholder dilution, this is an X on metric number 4. During recessions, overly levered businesses are at the greatest risks of losses. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. TC Energy ended last year with $42.5 billion of net debt. Right now, they have just under $44 billion in net debt. In this time, they've had negative free cash flow, meaning they've consumed cash in their business. This is an X on metric number 5. 5. Even if we were looking at this from the view of a utility company and we were considering their earnings, they've only generated $11.6 billion worth of earnings in their last 5 fiscal years. That's not enough to support their net debt position. While the company has a large amount of fixed assets, and it's partly in the nature of both midstream businesses and utility companies to use high amounts of leverage due to their high fixed assets, TC Energy doesn't support their debt loads using either their free cash flows or their earnings. Dig into the business to see if this could cause trouble or not. Before we get to the first of 2 different ways we're estimating a value for TC Energy, it's time for our bonus. As our bonus, we're looking at TC Energy's dividend profile. Right now, TC Energy pays a huge 7.1% dividend yield. People make mistakes all the time by blindly chasing dividends. We want their dividends to be supported by their free cash flows. That has not been the case in any of these 5 years, even as TC Energy has grown their dividend payouts over this time. They have supported their dividends using their earnings in 3 of these 5 years. That hasn't been the case since 2020. In their last 2 fiscal years, they have not supported their dividends. They've started to cut their dividends slightly as well. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. TC Energy doesn't support their dividends right now. This is an X on our bonus. The big metric of them all, metric number 6, we want TC Energy's average 5-year free cash flows divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for TC Energy. Right now, they have an $86.5 billion enterprise value. This looks at TC Energy similar to it being a private company. It accounts for both their market cap and their net debt position. In the last 5 years, we learned TC Energy has consumed free cash flow. They have both negative average free cash flows and negative current free cash flows. If we're looking at the company from the view of their earnings, in the last 5 years, they've earned $11.6 billion, meaning in an average year, they earn about $2.3 billion. When that's divided by their $87 billion enterprise value, that comes in at 2.6%, below the yield of the 10-year treasury. They've only earned $1.2 billion in their last 12 months. For TC Energy, both based on their earnings and their free cash flows, this is an X on metric number 6. Don't just throw the business out. We still need to estimate their fair value per share and give our rating. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze TC Energy, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. TC Energy has had low predictability in their past. That could also be the case into the future and can skew our assumptions. We're using the company's earnings per share instead of their free cash flows. This gives a little bit more credit to the company's power generation business. You'd still need to do work to figure out if this will be accurate or not for the company. We're using an average of their last 3 years worth of earnings, then using historical assumptions to grow these into the future. If we assume their 3-year average earnings decline at 2% annually for the next 10 years, then assuming that these decline at 5% annually for the following decade, if we add in TC Energy's tangible book value, which gives an estimate of their net worth, if we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years from now, an estimate of TC Energy's fair value per share is around $24.50. That's down about $14 from the company's current stock price. Keep in mind some key points. TC Energy has not been that predictable in their past. This could affect the future for the business as well. Different from most other companies, we're using their earnings rather than their free cash flows. That can affect these assumptions, and it's not money that can go directly into the pocket of shareholders. This discount rate is an estimate of total returns to shareholders based on their earnings. It's already including their big dividend yield, so their stock price would not be increasing by this full 15% amount. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to TC Energy, but we have to address something first. We've covered the numbers, but the qualitative factors may be even more important for TC Energy's business. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, the Canadian regulatory structure allows for greater recovery of costs due to project cancellations or producers failing compared with the United States. Number 2, the company offers virtually identical growth prospects and a projected earnings profile as Enbridge, but it allows investors to focus more heavily on natural gas. Number 3, TC Energy has strong growth opportunities in Mexican natural gas as well as liquefied natural gas. But we'd be remiss if we didn't cover the negatives as well, looking at the factors supporting a short thesis. Number 1, carbon taxes for Canada are expected to be 170 Canadian dollars a ton in 2030, putting pressure on pipeline businesses. Number 2, TC Energy is expected to remain more highly levered than most midstream peers over the next few years, as it's targeting high long-term leverage levels. Number 3, the firm is still expected to rely on capital markets for about 20% of its spending program, while Canadian and US peers are already generating free cash flow after paying dividends. There you have it for a balanced perspective of some of the qualitative factors behind TC Energy's business. Now it's time for our rating. In analyzing TC Energy, stock ticker TRP, we learned this midstream energy business earns just about average returns on capital. They've grown their revenues, but those aren't as meaningful for a midstream business. Both their earnings and their free cash flows are down. They've also diluted shareholders. It looks like the company struggles to support their debt loads using either their earnings or their free cash flows. They also haven't supported their dividends using either their earnings or their free cash flows since 2020. Their free cash flows especially are struggling. They're negative to date, and TC Energy has consumed cash in their last 5 years of business. It's worth reiterating this analysis is not financial advice. Neither their free cash flow or their earnings to enterprise value yield would look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis using TC Energy's earnings, if you believe those assumptions, these multiples are the same 20 years from now and you want a 15% rate of return, an estimate of TC Energy's fair value per share is around $24. They last traded at those levels way back in April of 2009. Looking at all the factors of our analysis, TC Energy looks like a very weak candidate for further research. Again, this is not a buy or sell recommendation of any security. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about TC Energy, and let me know what business to look at next in the comments below. Thanks for learning about TC Energy with me, and have a great day.